Welcome to Trailblazers. Today I'm here with Moses from Paystream. Moses, can you start off by introducing yourself and telling us about how you kind of came to be working on Paystream?
Okay, everyone, I'm Moshish. I started like Paystream idea kind of like 2024 quarter four, I would say. Like when I was like finalizing I used to be a security researcher on Ethereum, not on the foundation, but I just used to put protocols openly. So I did some like private audits also with a couple of firms. So what happened was I was seeing these problems regarding to optimization when I was seeing, especially when I was auditing yield-based protocols. So and I had some ideas. So I started thinking maybe I should build a protocol down the line. So I think it was 2024 DeFi Security Summit, which I attended. It was kind of like you could say like the eye-opening movement, and like there are some cornerstones when you're building a protocol. So that was my first cornerstone, which I kind of met Jack, founder of Cantina, and he kind of like would say pilled me to actually start like working on the protocol. And after this, like I finalized the white paper, and because it has to be done with a white paper. I know like people generally don't give a damn about white papers, but yeah, like that's how I generally came across starting the protocol itself, which is a bunch of problems which I saw. I wanted to optimize it, like because I had some of my solutions, and the reason I chose Solana was first the first solution which actually came into my mind was already implemented on Ethereum. So Morpho already did it like 2 years ago. So I was like, on Solana, no one is doing that, so let me try. And because there were some like major differences, even though when we were building Paystream, when it compares to Morpho and P2P engine and our P2P engine. But majorly, I chose like Solana because of that one sole reason, first mover advantage. Because if Morpho was able to move to Solana, they would have done that a long time ago.
Can you kind of talk about the problems that you saw and kind of how Paystream kind of fixes these specific issues?
Okay, so initially it started as like just a like lending borrowing protocol, which we're gonna build a peer-to-peer engine on with a fallback router, right? But we kind of run down with a very like I could say like major problem of liquidity fragmentation. So when you're building a fallback router, so you allow the users basically to say, hey, what kind of fallback do you want your funds to be in? Some people say Camino, some people say Drift. Now, this kind of creates a situation where even though you have, let's say, 1 million TVL, if it's pretty much distributed in different protocols. And as a protocol, it's far much efficient for you to, from the revenue perspective and for the, I would say, product perspective also to when you're providing the value to the user, that you're able to control where the user funds are actually going. So we decided to solve this one major problem, liquidity fragmentation, by coming up this like of a pool method. We call it LLP. It's basically allows users to open bigger liquidity provisioning positions on protocols like Meteora, Raydium, per se. Now, when we decided this made this pool, we also decided, okay, let's also take an approach to build a router which could actually work similarly to Meteora Hermes algorithm, which is basically this. So let's say Camino has 6% APY and Drift has 8% and margin Fi is like 9%. So it will automatically shift your funds to margin Fi. And whenever the APY changes, it keeps routing your funds to the maximum field. So this way you are able to give highest fallback yield, but we also are able to provide a mechanism with LLP which actually boosts it up. So what happens is like if you're an LP trader, let's say you love to LP on Meteora, you can with the help of LLP you can actually leverage in those trades. So let's say $1,000 with LLP, you would be able to open a position of $4,000. So now you're gonna earn fees on $4,000 base capital. And the more you leverage, the more amount of fees you're going to pay to Paystream, which indirectly goes to the lenders. And once that happens, so the P2P engine, it sits over the pool itself. So that gives kind of a huge amount of yield efficiency, I would say, on the lender part and also on the borrowing part, because the P2P engine is still on the basically fallback yield basis. So, okay, so I think it might get confused a little bit, users. So think of like this. This is your fallback protocol. This is a P2P engine. So lenders and borrowers are interacting from here, and this is your LLP. So what LLP gives is extra yield to the lenders, but only in certain tokens. It's gonna be mainly in SOL and USDC, and rest of the tokens it cannot happen because of the MAV and sandwich-based attacks. Because when you are swapping a token to another token, because when you are LPing, you're not gonna do LPing in SOL, right? That's gonna be pretty much your base token. So that's one thing which we want to avoid. So LLP allows you to have far much more yield in SOL on USDC, and P2P engine allows you to have extra yield not only just in SOL and USDC but across the markets. And even if both of these things doesn't work, you're getting the maximum yield from the router because the router is automatically deciding where to send the funds and the maximum yield to get. So it kind of becomes a problem. In the end, you get what is maximum yield as a lender, a solution for LP traders to actually LP in a way which never been done before, and borrowers are getting cheaper loans.
Okay. Yeah, for the people who are providing leverage liquidity, can you kind of explain like why they would want to provide leverage liquidity in this way and kind of how it works?
Okay. So from a user perspective, you won't be seeing this random numbers like is it going to P2P, is it going to fallback, is it going to leverage liquidity. As a lender, you will simply come and deposit funds and forget about it. What you're gonna see is the APY number. What you're gonna get.
Okay.
And when you compare the APY number to one of these pool-based protocols, you will be automatically able to say, hey, the yield is too much here. It's simply like too great to not want to have funds here versus on other protocols. So that's pretty much going to be the sole reasoning factor as a lender that you should be considering when you're putting funds. Like that's the one major reason, right? If you want, like if you're putting your funds to get the maximum yield, you should be putting it to a protocol which is actually able to get you that maximum yield. So it's pretty much the only factor which you will be seeing as a lender. So because you're not going to see this factor like, oh, am I the lender which actually going to provide funds for the leverage liquidity, or am I the lender which going to provide funds for P2P engine? You're not going to see this jargon. This is like just for the folks who want to know like how does things works under the.
Oh, okay, so it totally makes sense. So you kind of aggregate all these strategies into kind of like a one-click solution so that people just know kind of.
Because like that's also one of our like major approach that we're trying to do is like dumb it down. Like there's like too much jargon going on DeFi space these days. Like I mean like it makes sense if you have like let's say because like generally big whales says you have $10 million and you have $8 million in cold wallets where they earn yield and $2 million in hot wallet where you basically LP. This is a particular guy example which I'm taking here, but yeah, so this is what you're gonna do is basically you're gonna put $8 million into a protocol which can get you that maximum yield, works with a bunch of routers, and $2 million you can LP with, along with leverage via LP. It's gonna be like terminal interface. So if folks do want to go into like nitty-gritty details, they should be able to, but it's we would make it like as clean as possible.
And can you describe kind of how the P2P lending side of this works and how it compares to like a normal kind of lending?
Okay, so I would say like this is like it's as so peer-to-peer is pretty much same as a bank, but the banks can provide you under collateralized loans on-chain that doesn't work. So we have this thing called over collateralized loans. Peer-to-peer actually solves major. So when peer-to-peer architecture-based protocols, what happens in those protocols is basically there's something called utilization curve. And they have to make sure the utilization curve is not being abused. When I say abuse, I mean not getting utilized too much. Because then a lot of issues come occurs like lenders are not able to withdraw the funds because queue starts to form, and that's like the very very niche case which I don't think it has ever happened on Solana. On Ethereum it has happened like a bunch of times, but not on Solana. And there are like other factors also, like let's say yield changes across the year, right? So APY gets fluctuated. So how do you promise those returns to the lender? So you promise those returns because like if it's a pool, you can ship this pool to one borrower or multiple borrower parties, and they can deposit the, I would say like the interest whenever they seem to do or want to do. Or I mean like there's like still various architecture differences. Like some protocols prefer to have a time-based borrowing thing. Like you can only borrow for a certain duration, then you have to deposit funds, otherwise we will liquidate you. Or in other protocols, it's completely different. Like you can borrow and just like how Drift and Aave, like Aave does it, right? So Aave has a APY per block thing. So they index the APYs per block. So it doesn't matter if you're borrowing for 1 day, 2 day, 1 year, 2 year. Whenever you're gonna when you're gonna come and actually repay a loan, you will gonna pay the interest which you're actually bound to pay. So these kind of problems are basically, they have to make sure the low utilization is there to make sure the lenders are able to withdraw the funds when they want to. It's as same like if you think about it, when a market crashes, what happens to the banks? Let's say on one day you suddenly decides every bank saving accounts owner decides to go and say, hey, I want my money back. Now that's going to be an issue, right? So it's pretty much the same thing with, I would say, a peer-to-pool. But that's not the main reason which you're solving, because that's a just typical one example of how peer-to-pool architecture works. Peer-to-pool architecture prefers low utilization rate because they want to ensure the lenders are able to withdraw, due to which what happens is something called wide APY spreads. So what happens is your borrowing rates and lending rates difference start to get bigger, because what they want to ensure is like if the price is fluctuating, they should be able to handle that buffering. So now this creates a problem in which lenders are earning less and borrowers are paying more. So this kind of creates this kind of a spread between the APY rates. So here P2P engine comes and actually bridges things. So what P2P engine does is they simply calculates the average APY of the underlying protocol, which let's say any kind of a pool-based protocol. So let's say Camino is giving 6% lending APY, 10% borrowing APY on SOL. So on Paystream, P2P engine, you're going to get 8% P2P APY, which is same for lenders and borrowers. So as lender, you're going to get 8%, and as a borrower, you're getting 8%, which is 2% cheaper from a borrower perspective, and from a lender perspective, that is 2% higher when you're earning yield. So that's how Paystream P2P engine works. And if there's no borrower to borrow from, hey, you're at least going to earn the maximum yield from the fallback router. So it's a win-win situation for you.
Okay, and then is there like flexibility that you have to give up to kind of participate in these P2P loans?
Yeah, so the major factor still comes with this thing, which is there's always certain like op security risk, which generally comes with a smart contract. But from the design perspective, there was a liquidity fragmentation risk which we solved. The second risk, it's the withdrawal limit. So what generally tend to happen with peer-to-peer and architecture-based protocols is this: let's say there's a lender A and there's a lender B, and there's borrower A and borrower B. So lender A is matched with borrower A, but what if lender A wants to withdraw the funds? So how are you going to do that? So there's a case like the lender B has to have enough capital that they can support borrower B also, but they can also take a place of lender A. If they can do that, then you simply switch to the loan here. But if that doesn't work, then that kind of becomes an issue. Then you have to basically start to pre-liquidate the positions, or you have to start introducing queues. So that's like one of the major, I would say, like side drawbacks that comes with Paystream peer-to-peer engine in general. Although we are working on the solution, but I wouldn't say too much on it because it is still like very early stages. But it should be allowing that we can issue a secondary loan from the underlying fallback and can issue it with the borrower. So that way, borrower will have to pay this higher prices, a little bit more, and lenders are able to withdraw the funds. So we should be able to cut that cost. So because like in the end, if you are using a secondary loan, you have to pay a lot because you're going to use the underlying protocol rates, right? So you have to kind of distribute it across the lender and across the borrower. So you can kind of dumb it down through this. If you want to withdraw funds and if you're matched, we can allow you two options. You can withdraw it right now, but you might get less yield. Or you can wait for like 7 days and you can get the yield which you want to. So that's pretty much it's gonna come to like, but yeah, that's one of the like I would say risk from an architecture perspective that comes.
Okay, so you guys kind of made like a trade-off here where it's like the pools allow this kind of always instant like withdrawal, but then the problem is because of that they kind of have to have this spread onto it, and so you guys like if you're okay when something kind of goes crazy to wait through some sort of queue, then you can get a higher APY kind of than somebody who's operating in a traditional pool.
Yeah. That's pretty much like I would say like perfect way to summarize like peer-to-peer engine. Yeah.
Okay, and then so how are you guys thinking about kind of getting borrowers and lenders on, or borrowers and lenders onto your platform and kind of bootstrapping this use.
So here's the thing. So I think before I answer the question, we need to learn like how we're gonna ship the product itself. So today is like 8th November. I don't know when folks are watching this video, but on 15th of November around the same time, our terminal gonna go live, which is like the LPing terminal, where users will be able to LP. Like it's gonna be in very early stages because it's like certain amount of features are only developed, like basic ones. There's still like it's basically the features have been decided into 4 phases, and the first phase is gonna be deployed on 15th of November, and post that these things will be deployed, and after that peer-to-peer engine is gonna be introduced. So when around phase 2 end, you're gonna have this leveraging LP terminal feature, which will allow LLP traders to actually borrow funds, because they are technically borrowing funds from the lenders. But I wouldn't say, because like so it's kind of okay. So technically you're using this leverage liquidity, so you are a borrower, but borrower generally can use the capital for any kind of purposes. In this case, the trader is only able to leverage that capital to open a bigger position. They're not able to do anything particularly with that capital. That's like very much limited use case. So our goal is basically with the LLP itself, the borrower's amount that actually being borrowed from the lender pool or the leverage liquidity pool is going to be higher. We want to ensure that this feature is, as I would say, easy to use. It's pretty similar to like perpetuals or some sort of things, and we can actually increase the amount of users who actually do LPing with this particular feature, because they are able to earn higher fees. And the more the borrowers are actually using this feature, the higher the yield gonna be for the lenders which have put the funds. Now, once the P2P engine comes, the market's gonna increase, because as I said, LLP only supports SOL and USDC markets. It doesn't support more than these markets. So if you're, let's say you're any other token, USDT, Jito Sol, Jup Sol, Jupiter per se, so like it's another so many tokens, right? So in those cases scenarios, we have to see how can we introduce a way of having more borrowers on chain. So other than having incentives, right? So the only way we have to do is maximize this approach is basically by giving the yield rates as the sole reason for the borrowers if they want to borrow. So it's basically what I'm saying is, if you want to borrow, you should be able to borrow from a protocol which is actually giving you far much better rates versus paying higher rate and borrowing it from there. So in the end, it comes down to a decision: do you want to borrow from a new protocol, which is kind of like in its infancy I would say like in infant stage, because it's a new protocol, or do you want to borrow at a higher price from like I'd say like a little bit established protocol for like 3 years? That's the only reason comes from. So as for our strategy on how we're gonna approach this, is this simply our focus is on the LLP side initially, because the higher the volume on the LLP side is, the higher the yield is gonna be on SOL and USDC, and that will attract a lot of lender funds to deposit in it. Borrowers and will only start to come once we have gotten at least a single audit post public launch, around not like pre-public launch. And once that happens, we have this whole incentivization program like based on seasonal drops, which should be able to get these borrowers come and borrow from protocol. And that's not only it. We will have some kind of preset of strategies built in, which allows users to basically borrow and also lend. And basically, it's in simple as terms like this. People will do this. So developers will also build preset of strategies, because it's pretty much going to be an SDK kind of a thing. So what's going to happen is this: if you're a DeFi yield farmer, what you do is you go and basically deposit your SOL in some kind of against a LST. Let's say in this case, let's say Helios. So what you get in return is HSOL, right? You get some HSOL, and then you go and put it into some kind of a pool of an HSOL. So you have basically earning some sort of a yield from SOL by staking it. You're getting HSOL. Now you have lended the HSOL. You've gone and now borrow against that HSOL some sort of SOL and USDC, and then you put that USDC to long SOL. So now if you want to borrow that USDC, you can come on Paystream because you're going to get the better rate, cheaper rate, I mean. So in those sense, like these preset of strategies will make more sense for lenders and borrowers. So it will become kind of a, so the one thing which people kind of takes it wrong when I say considering Paystream is like we are a competitor of Camino or we are a competitor of Drift. We are not. Our goal is to do only one thing, which is optimize liquidity across Solana. So if you are doing any kind of DeFi strategy, Paystream will be a part of it because you will get far much better returns if you're using just Paystream, P2P engine or LLP per se.
Okay. So you guys are basically gonna have like kind of product-led marketing in a way where it's like you guys are going to be the most competitive protocol on these specific strategies that people are looking to do, and therefore if they're willing to kind of take the risk on a newer protocol, then you guys become the obvious venue.
Yeah, pretty much that. If you are willing to take a little bit of risk on a protocol which is like single audit, like just recently started, and you're gonna get the return. And
Okay.
that's how we're gonna build that trust in the start, and following with multiple audits gonna follow up, and within 2 years everything's gonna change. That's like pretty much my bet. Yeah.
All right, totally makes sense. So I wanted to switch topics a little bit and talk about the MetaDAO launch that you guys did. Can you talk a little bit about the decision to kind of launch on MetaDAO and then kind of your experience kind of doing the launch?
Okay, so play backstory. Like I think like we started. I started like I had my first meeting with Profit around in July, I would say. Well, I think it was end of July or first week of August. Like I'm not sure like what date was around, but like yeah, I had my first meeting around that singular point. And at that point, I was like not sure that much, to be honest, for the ICO and everything. But I was not sure. I was still considering my options and every sort of thing. We had our first meeting. Then I think we were considering like let's build a protocol. Let's like we were so much focused on the protocol. I was not even considering fundraising and like so much like deeply up per se, because we were focusing on simply these kind of architecture, how we're going to build a protocol, how we're going to get to a PMF, how we're going to approach GTM and those sort of things. Although we do have a like some early version of the build, I would say, of the deck. But post like have the first meeting, I think around end of August, we decided, okay, now we have to get the money because we have to build this protocol because the infrastructure cost is pretty much heavy. So how are we going to do that? So we have two approaches. Either we go and raise via VC or we go MetaDAO ICO. Right, and by the around point, we also already had MTN Capital, I would say, liquidation already happened, I think, in September. And OmniPair already raised around the same, on the first meeting which I had with Profit. So my question with ICO pretty much was this, like, I like the notion that they had undruggable ICOs. So like, okay, if I'm not able to rug, that's not only promote token holders, I would say, like they would be able to see the value. Okay, I think I'm framing it wrong way actually. Here's the thing. So yeah, so from a token holder perspective, it's gonna be easier to actually hold a token of a protocol which is undruggable when you're participating in an ICO. It's gonna be different, and we have the choice to be one of the few projects to do it in the space, to be the first ones, right? So we can be one of the few projects. Or the risk was this: what if the liquidation of the treasury happens within 6 months? Because then it's kind of become a short-sighted project. Because I was not sure about the users who actually hold these tokens are actually aligned with the protocol or not. So that's kind of the pros and cons. The pros was basically it's a community governance-based protocol, and if you know anything about Aave is so much community governed protocol these days. Like it has like become a huge. The whole success of Aave has been mainly because it has been so much, very much governed with the community itself. So I was like, we are approaching a lending protocol, and let's say we approach it with a community ICO, because like it's pretty much a futarchy-based ICO. So having a futarchy-based protocol from day zero, it's gonna be a huge plus for us. Lenders and borrowers will trust. Like if you think about it from a first basic principle, if as a user, as a lender, you can participate in the conversations, you can control the treasury, you are not gonna get drugged because some random founder decides to. You will be far much happier to put your funds into that protocol versus a protocol where these things are not in your control. So we simply, like from that particular principle, if you think about it, this makes so much sense now. So I was like, although it wasn't this easy because I did my due diligence on, I would say, like Omnipair holders per se. Like I got like this like whole Dion thing script, and so kind of scrapped it out, talked with Colin, and in September I think like second week, no first week, Colin told Colin that I think we want to do like raise with I would say Metadao, and he was like, yeah, sure, let's do it. And that's when they decided, and from that perspective, like from that point, I would say nothing much changed, because what we were doing initially was like focusing on the product. We did our due diligence within a week, said yes, and yeah, pretty much done. Like it wasn't like not something like we had to go through a lot of things, and I would say like we hadn't to do anything. Like we simply stayed focused on the product since day zero, and we are still pretty much focused on the product. So it wasn't like that kind of a thing like which you have to, because like the one of the major reasons also was this, like in the VC raising path, like you have to go and raise like, and have to go through like I would say 99 rejections to get that one VC. And I have done that. Like I have gone through like certain amount of VC rejections, and it didn't make sense to, because like we already went through like tier 1 VCs, like at least I would say like 24 or 25, and the timeline was looking at least 3 months, and we were running out of runway also very fast. So we had to do kind of a strategy based choice also there. Like, okay, either we chose, so it was pretty much the pros and cons which I told about Metadao, but also from funds perspective, it was not making sense to do a VC based round.
Yeah, so they kind of just made it so easy for you guys, basically.
Yeah, so it becomes like very much a simple, like easy choice to like, okay, let's go with the Metadao, and let's I would say go ahead with this. And so it only took a week, and yeah, we were pretty much done. Like although we had like a couple of calls, I had like although I had my doubts, to be honest, even when the ICO was going, because our ICO was the last ICO, right? And permissionless ICOs were not going good. Price was a little bit lower because like comparison to like featured ones. So I had my little doubts, but in the end we pulled off. We did around 6.1 mil, and we, I guess, like our cap was like $750,000, and I was like, yeah, that's great number. And that I was not thinking like it would work out, but it did work out. So I was happy, like, hey, now we can actually build again, because that 4 days was like gruesome, like. Because I was thinking, like, what should we do in this particular 4 days? But yeah, it wasn't like such thing like people are expecting, okay, we have to do XYZ things with Metadata. No, it was a very, very like simple, straightforward process. I think like we just simply asked questions regarding the business and every sort of things, and we had a couple of calls, and in 1 week I said yes, in September, I mean, and yeah, after that everything is pretty much like very easily like done. So yeah.
Awesome. Kind of going forward, what's like on the horizon for you guys? What do you at Paystream, like what's kind of most exciting you guys right now?
Oh yeah, so the launch, I would say. So the couple of things which I did was like, so I know token holders are very much anxious when the price goes down. Everyone is. So surprisingly, most token holders haven't read the docs of Metadata. Otherwise, they wouldn't be that much anxious regarding the token. But so I started, the first thing I did was like I will address the community like on a weekly purpose, like from a weekly blog, like this whole thing, 12 week thing, in which we will be having this like weekly update thing across 12 weeks, which will allow us to finish a protocol into a very, very great stage, but will also allow us to build some sort of a trust with the community. Post that, we will shift to a monthly based update. So that's like the approach we took from the community from the day zero. But the most thing which I would actually like a lot of like excited to build right now is the terminal launch on 15th or on the 15th of November. I mean, like I'm throwing the 15th of November date like this, like it's a some kind of a video launch or some sort of thing, but it is a very big thing because I think like I have published some sort of a designs, but the design is very much, the UI looks really great. We have worked really hard on the product, like from the back end and from every sort of thing, and the best part is like there's still so many features that are still left, and we definitely know once these features get shipped, LP is gonna love this thing because they will be able to basically do LPing through a single base terminal, and also gonna earn the maximum yield through a single base single terminal. That's kind of a thing which we are mostly excited about, like the product, I would say, because yeah,
Awesome.
it's
Zooming out a little bit from like what you're specifically working on, what else in crypto kind of has you excited other than maybe specifically what you're working on now?
Sorry, can you repeat the question?
Like what part of the crypto space kind of has you excited other than like what you're specifically working on?
One thing which I'm not excited about is the AI part. It's completely bullshit in my perspective, to be honest. Like, you're not gonna see agents do any kind of a thing with finance in a very short duration until they fix this whole hallucination thing. So that's the part which I'm not bullish about. The thing which I'm bullish about mainly is, I would say, like ICM in general, because I think I think I'm not sure if this is gonna happen on Solana or is it gonna be like, I'm not sure about the chain, but I'm thinking like from a far much like I would say like zoomed out like perspective. I think Coinbase might be able to do it, or some kind of legal firm. But yeah, so I think, imagine having a farmhouse in Kansas or like some kind of Texas, like random, I would say, region or state. Like Texas is just one example which I come from, and you have this own like some sort of a ranch, and now you need some sort of a money to basically have cattle stock on this particular ranch, and you go simply launch a proposal and say, hey, I want 30,000 or 50,000 or $100,000, and I want to have this, and I want to have this for any kind of XYZ reason. But you're able to do this whole thing without going to government or any sort of a thing. The end companies handle the process. You have to just sign a bunch of documents, and you're good to go. You are able to raise $100,000. You're able to start this whole business which you wanted to have, this whole cattle ranch in Texas. If these companies can solve that small problem of raising money, we can have a Kickstarter V2 which is far much bigger.
Yeah,
So
totally.
that's a part I would, yeah, because like we can help a lot of people in that sense also. Because if you think about it, meme coins have pretty much net negative to the whole ecosystem. The only net positive which I believe, it's a very kind of, I would say, like a hot take, or I don't like, though I don't give a fuck, but the meme coin, when they generally donate to charities because they have earned so much money, and those kind of sort of a thing is, I would say, like the only net positive that comes out of meme coins. Other than, I would say, like quick cash that folks make. But yeah, like that's one of the major. So if you just apply the similar concept to ICM, I would say people are able to raise on chain without so much going through this legal hurdle. And yeah, that's gonna be like the biggest thing, I would say, because so many folks, like so many small businesses will be able to raise, and so many new creators are also gonna be raising money. So yeah, I think, and the best part is like in Meteora is like very kind of a decent position. That's why people compare Meteora to Kickstarter, because like people gonna be able to raise any kind of money for any kind of a startup, and market's gonna decide if that's a good thing or bad thing. And I definitely know markets are far much better approach than a typical DAO governance, because if you had a beef with one guy which holds around 10% of a token, oh my god, he basically gonna sell the token, tank the whole graph. So or gonna just pass random proposals, and he will have the higher voting power. So in that sense, I do believe like market has a far much better chance to survive. So that's like, I would say, like ICM is one thing which I'm the most excited about.
Yeah, it seems like it's really kind of, I don't know, providing value to people in a way that is like really instant.
Yeah, I mean, like, yeah, please go
There you
ahead,
go.
please.
There you go.
Oh, so I was just thinking like, I just wonder what's gonna happen like when Bitcoin kind of becomes the actual reserve, instead of like the gold's gonna be always there, but like I do want to see Bitcoin as a global currency like someday. So I think like if that when that happens, like that's gonna be the real actually shift in the economies of like across the globe. But I don't think like we're anywhere near to that point. I mean, like we do see a lot of like acquisitions happening with both U.S. government and Chinese government, but nah, we are not like nowhere close to it. But yeah, that's something also kind of a thing. It's not something which excites me, but I would say it's some kind of an indication point that we're moving towards the right direction. Because when governments are involving in buying these kind of tokens, which are kind of reminds me of the cash, which people believe governments and firms not gonna buy just because they are against this privacy and whole motion, which I don't buy it. In the end, it's a capital. If they want to buy, they will just put a couple of $1 billion and it's gonna be good. So it's not like that's a kind of like, I would say, stupid argument which people have on the Zcash basis that okay, governments don't want to buy this because it's privacy back thing. I mean, like they don't want to buy it because it's not big yet. It's pretty much that. Once it goes big enough, I would say like everyone consider it as an investment, and when everything becomes an investment, people buy. But yeah, like it's completely actually unrelated to the topic. Sorry. Yeah, please.
Yeah. Well, I think this is a great way to wrap things up. Thank you for coming on and sharing your thoughts, telling us about what you're working on.
Yeah, thanks for having me.